Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
So Dana, have you learned any new skills over the last year during the whole COVID lockdown or anything like that?
Oh man, what a hard question. I wish that I could say I did, but I started a new job during the lockdown, so that's my excuse for not having picked up any new skills, I would say.
How did that go? Was that job search just all online and interviewed online?
Yes, and let me tell you that there is a silver lining to that because, I was able to interview with 6 firms really, well down the pike on several of them. And, I got to do it basically from my home. I didn't have to go in person. So if you think about if you're in a sort of high stress job and then you're trying to do a job search as well, it's a lot. And if you were having to travel, which prior to COVID, you'd be expected to go out and meet people in person, right? And be flying out. I kind of got to just do it from Zoom, which, on the one hand, you don't meet people, but on the other, it's more efficient for sure.
So I'm speaking with Dana D'Auria, co-CIO at Envestnet PMC. She's a member of Envestnet PMC's investment committee and has many years of experience managing and implementing investment solutions for wealth managers. And this is one of the reasons why I wanted to talk to her today and talk about the state of asset allocation, among other things. We actually have quite a wide variety of topics to cover. You even sent me some homework to read, so which I jumped into.
You asked for it, Ed.
I did. And as we were talking about, she recently started Envestnet. What was it, September of last year, 2020?
Yeah, that's right.
And prior to that, you were at Symmetry Partners for quite a while. How did you get your start in finance? Was that your main goal coming out of college?
No, I honestly wish I could say it was, but I didn't really have a firm grasp of what I wanted to do for the rest of my life coming out of college. So I ended up going into journalism, actually, because I was a journalist in college and high school. I was always on the paper. And so I said, okay, well, I'll do this for a while, see what kind of interests me. And so I ended up at the large daily in my area. It was called the Connecticut Post. And I ended up on the business section, writing about markets, writing about investing and business. And I said, okay, this is pretty interesting. I was one of those people, everybody I went and interviewed, I said, I kind of had that, I guess, natural curiosity and thought, oh, that's interesting. Maybe I'd like to do that. So I sort of, after writing about it, I decided to go back to school for an MBA to use that to facilitate a transition to investments and finance.
So, our audience is a mix of individual investors and financial advisors. And for those listeners that may not be totally familiar with Envestnet, can you explain a little bit about what Envestnet is and currently what your role really is on a day-to-day basis?
Yeah, absolutely. So Envestnet is a really interesting enterprise. It's a data aggregation firm for the investment industry, but really it kind of started life as a turnkey asset management program, or really got going as a turnkey asset management program, offering thousands of asset managers out to a huge network of independent broker-dealers, insurance broker-dealers, regional BDs, as well as independent RIAs. And so what's happened with Envestnet is it's been very acquisitive. It's also, Envestnet's very good at, the executive team is very good at looking at, okay, this is a place we need to be. If we're going to offer holistic solutions, I know that word, right? What do we really mean? We mean we need to offer to the advisor any aspect of financial wellness that they'd want to deliver to the client. So how are we going to be in all those places? We're either going to acquire or partner or build. And so they've been very good at, kind of doing that and assembling this great ecosystem for the financial advisor to play in. So now Envestnet's really, not only does it have that core technology turnkey asset management program, but you have really important other aspects of the business like Money Guide Pro for financial planning or data analytics to help advisors figure out what should I be doing with the client, right? Bring data to bear on this question. So now you can think of Envestnet really as a technology firm, but delivering data and tech, kind of using data and tech to power better solutions for advisors. And my role, you asked, so Co-Chief Investment Officer, really in terms of the TAMP, we have a whole asset management arm as well that's been built up over time. So if you talk about, okay, we want to be able to deliver any solution that the advisor needs. Obviously, a lot of those solutions are asset management solutions, whether it's products, models or research on all the other asset managers, or direct indexing solutions where we buy direct equities. A huge one that's really important now, and I'm sure we'll probably talk about this a little, tax overlay. Right? A lot of advisors, are looking at the tax proposals. You probably saw there's potentially even retroactive capital gains increase, right? So very much in the news and a very important product line for us. So as co-chief investment officer, I'm kind of overseeing that effort.
So in more simplistic terms for myself, it's helping advisors build asset allocations, implement asset allocations, and pick the funds that go in, the strategies that they offer to their own clients, and with all these other external factors to consider as well.
Absolutely. Yep. Pick the right solutions, pick the asset managers, the allocations, as well as, tax management, impact management. So a big one for us too is, the move to ESG, impact investing, right? Sustainable investing, and helping advisors figure out how to incorporate social preferences into their client portfolios. That's, clients are asking for this, and advisors and home offices are saying, okay, what used to be sort of a niche kind of a thing, right? Socially responsible investing. Now the spotlight is on it, and everybody's kind of asking, well, should I be considering this? Should I be looking at it?
Yeah, we're going to talk about that a little bit more in depth. But I've been looking forward to this conversation because I've been wanting to talk to somebody like you that kind of has oversight of the whole portfolio, if you will, or different asset classes, and helping people kind of figure those sleeves out. Because there's a lot of different topics going on in the marketplace today. One being the status of the 60-40 portfolio, where it's 60% equity, 40% fixed income. Kind of been the rule of thumb generally for just a kind of a nice long-term portfolio and something that's diversified. But in today's environment, consider this, is it true or false? The 60-40 portfolio is dead.
Dead is such a strong word. 60-40 portfolios have powered so many people to retirement and done a great job. And there's a reason for it, right? It's balanced. It's the risk level that a lot of people can accept. I think the problem today with the 60-40 is you're dealing with, if I have $1 million to invest, 400,000 of it is going into, if it's going into traditional fixed income, it's facing pretty low yields, right? Maybe negative yields at this point. So negative real yields.
And increased risk, right? With the super low interest rates, the risk of rates rising.
Yeah. And, and exactly right. I mean, we experienced this year losses, negative 3% in fixed income. So people who thought of that as the risk mitigating part of their portfolio and didn't really think, that you could have that level of negative return on the fixed income investment. For all these reasons, the questions are coming in, okay, do we need to look at other ways of doing this? And, certainly there's always the ability to take more risk and just move more into equities, which in a certain sense, I mean, depending on the risk reward relationship that you're focused on, that in some cases may make sense, right? Because if the risk is running out of money and, if I did a simulation and said, okay, I actually have a better chance of getting to retirement in a 70-30, let's say, than a 60-40, given what I'm going to earn on the fixed income side. But as we all know, the risk of that is a little bit tough to swallow because you've got additional drawdown risk with equities and, then a client who can't stay disciplined in that. How do they manage that? So I think where we're going and Envestnet is increasingly working on bringing in, for example, the ability to use more liquid alternatives, the ability to even look at options that are, perhaps off-platform assets, hedge funds, et cetera, looking to basically expand the opportunity set so advisors can diversify better and they can also look for return producing opportunities elsewhere. And, something that kind of sits in the middle, right? So maybe I'm not going all the way over to the risk of equity, but I recognize that, fixed income alone I maybe want to diversify that position a little bit. So it's definitely on the minds of our advisors, our home offices, and Envestnet works hard to give access to, any of these types of strategies that we think make sense.
Yeah, we're hearing a lot of people looking for different solutions, other parts of the fixed income market, other regions perhaps of exposure, or hybrids, even like preferred, something like that. Mm-hmm. And been hearing more about alternatives and private equity as well, or private income. That would be really interesting.
Yeah, interval funds are, I don't know if you're hearing that, Ed, I'm hearing more and more about, so interval funds, you have windows of liquidity. It's not all the way over to, sort of private market, but definitely an increased interest in these types of vehicles.
Now, one of the other hot areas of the market, and even within the product space or the product developer space, is thematics. And people seem to be pretty hot on thematics, almost to the point where like sectors don't really matter anymore. It's all about thematics. How, given the outsized market returns that we've seen from some of these hot sectors and other, even like crypto, for instance, how do you think about evaluating some of these things, whether it's thematics or crypto, and incorporating that into a portfolio?
So the way I think about it and approach it is that thematics can be a very nice way to bring people into a managed account type of philosophy, right? So if you think about where a lot of people are starting their exposure to equity markets nowadays, you're getting more and more directed brokerage. You're getting more people, especially during COVID, right? People were home. We had data from Yodlee showing us that de-identified that people were using their COVID checks to actually start up brokerage accounts, right, and trade individual securities. We have now the rise of meme stocks. Right, GameStop. So when you think about how a lot of people are getting their first entree to equity markets, thematics are a really interesting way, I think, to sort of bridge people over to more of an investment way of thinking as opposed to a speculative way of thinking. So I think, thematics can be very interesting if an advisor can kind of offer that as, okay, we have this piece, we know you're very interested in this piece, kind of goes after some aspect of the market that you're interested in, but let's put next to that, a more diversified portfolio, right? Let's get some, well-diversified broad market exposure from equities and fixed income. Crypto, I think, is its own sort of exploration for sure. We're well immersed now in how will we approach crypto, right? We have advisors who want access to crypto in their portfolios. Their clients are using Coinbase or they're using PayPal to get access to Bitcoin. And the advisor doesn't want to be on the side of that. They want to say, well, how am I going to potentially include that in the portfolio if it makes sense to do so? So we're exploring, okay, what does that mean? What's prudent? What's not prudent? Unfortunately, access options, as you know, Ed, are not great in the US, right? You don't have ETFs or mutual funds. This is the preferred method that advisors want to access this market. And regulators are not prepared to approve that. So instead, what you have going on is the opportunity to get through, say, a trust, grayscale trust, maybe you can do futures, you can just own crypto directly in the portfolio. But each one of those is a little different and carries different risks and different trade-off than I think advisors would love, right, to just be able to do an ETF.
Direct indexing, that's also a really fascinating little area, I think, that's growing. And is that still focused on U.S. stocks, or can you direct index even internationally or fixed income at this point?
Us personally, or just generally speaking?
Well, I guess generally speaking, but from your experience there, I suppose.
You can definitely, so direct indexing can really run the gamut, right? If you can sample an index, you can direct index against it. Our service currently is U.S. equities, and we also do get access to international. We have quantitative portfolios that get international access via ADRs. So that's kind of how we skin that cat at the moment. We are looking at entering into fixed income and opening up other opportunities there. Direct indexing from our perspective is going to be big. There's no question about it. Fractional shares right now are, you hear a lot about it. I don't think it's quite there yet in the way people think. It's not, you can't invest $10 in the S&P and get an equal amount of 500 stocks or a prorated amount. But as fractional shares grow, as they become available in the advisory space, you're going to see, I think, more and more people who they're just going to expect that they can access the market via some customized portfolio, like a direct indexing option. So what used to be sort of the paradigm of ETFs and mutual funds, where I accept the packaged product, I accept whatever everybody else is getting. I think because of just the advent of these things, commission-free trading is another one. I think you're going to get very much to a point where investors are going to say, well, why can't I just take out XYZ stock? I read an article. I don't, I'm not happy with what they're doing. I don't want to support that. I want to, take my money out of that. And I think it's going to kind of become obligatory for asset managers to offer that.
Seems it will go hand in hand very well with ESG mandates or desires.
For sure. There are a lot of people who say ESG is a very personal thing and it has to be very personalized. I would say that's the case for some, right? Certainly, there are many people who look at ESG and socially responsible investing, and they have very specific social preferences that they want to express in their portfolios. And so absolutely, Ed, you need, a direct indexing type solution for that. I do think also, though, ESG is a much bigger, has a much bigger audience. And there are certain, plenty of people, certain groups that are perfectly good with a packaged product from that perspective, as long as that product is going after whatever aspect they're most interested in, right? So you can have an ETF on renewable energy or water preservation. And alternatively, if you're interested in ESG because you're trying to reduce ESG risk, you may be perfectly fine with an asset manager saying, okay, I'm doing the work to determine which companies are well positioned for the physical and transition risk that we're going to face. I'll offset that to them, right? And that's what I'm outsourcing for. So I think you're going to get both. I think you will have an audience for all types of products there.
And what we're talking about ESG is environmental, societal, and governance for those that may not know. S is societal, right? Or
social. Yeah.
Social.
Yeah.
Something similar.
The idea is right.
Right. Which is super interesting. And perhaps we could talk a little bit about it now since we kind of brought it up. It's been a lot written about it. It used to be known as SRI and probably a couple of different acronyms, socially responsible investing. And now in its latest kind of flavor of this is ESG, covering some different areas of analysis, whether it's on the environmental aspect side or the social side or the governance side. What has been your experience in terms of interest from advisors for incorporating more of that? What have you seen?
We're seeing a lot of interest. So let me give the context. It starts from a small base, right? Like relative to the assets on platform. So we track impact tagged assets. We have about 31 billion currently on the platform in impact tagged, which is any number of those themes that you just mentioned, across, all of, $4 trillion in platform assets, right? And actually we're tracking a subset of that, but still, certainly the base is relatively small. It's growing dramatically. We've seen well over 100% growth in, movement into these types of strategies over the course of the last year. So we're absolutely seeing increased interest. We're seeing advisors looking for help from a practice management standpoint on how to approach this. And you mentioned sort of 1.0 of ESG is this SRI, right? Socially responsible investing. And I think a lot of advisors and home offices, it really got ingrained in them the idea that SRI means lower performance, and SIN stocks actually tend to outperform because we had pretty good academic evidence around that, right? Like there were several papers in the last couple decades that said, hey, look, if I remove tobacco or gambling or firearms from the portfolio, I'm removing higher performing stocks because those quote unquote SIN stocks tend to outperform. And so a lot of advisors sort of just kind of learn that mantra that SRI means underperformance. And what we're trying to do is engage advisors and educate on these new products, right? To your point, the E, the S, the G, or the ESG are a different beast, and they're not subject to the same studies that were done on SRI. So if you think about the old SRI portfolios, and pensions and endowments used to invest that way, eliminating these quote unquote SIN stocks. I mean, from my perspective, you'd have to say, well, hey, look, if the SIN stocks return more, then you were successful, right? You drove up their cost of capital. And that was the idea behind it. It wasn't an alpha thesis that those stocks were going to underperform, and that's why they were taking them out. ESG has a very different posture. We have yet to see what the alpha thesis on ESG will do. We don't have the data yet to know, right? But there's absolutely an alpha thesis there that didn't exist for SRI, and potentially even a beta thesis. And what I mean by that is if you believe that there's unpriced risk around, for example, environmental, right? That we're transitioning to a world where we have to reduce our carbon emissions, we have to move towards renewable energy, then companies that are embracing that and preparing for that are going to do better from a cash flow perspective than companies that are not. So the question is that an unpriced risk at a systematic level? Is it an unpriced risk within companies? Is there an opportunity to outperform that way? And that has yet to play out. The interesting thing too is governance, which is very old in the literature as well, is similar to quality. And that's actually a beta thesis, right? Quality is kind of established in the literature at this point. High profitability, good governance, these things kind of go somewhat hand in hand. And, that's been blessed as one of these style factors that does outperform over time. So there's a lot there to unpack, but it's very much a different, vector than the old SRI way of thinking about things.
Yeah, definitely. I had a previous podcast guest, Mark Sloss, last year, and we talked about ESG, and he noted the perception or the misperception, as he would put it, in terms of SRI concessionary returns, I think is the way he put it, was largely due to apartheid in South Africa and the divestiture movement that happened, I think, in the 80s, where South Africa was still a vibrant economy, but because of apartheid, Western economies were divesting themselves of investment there. So they missed out on returns. That's kind of what stung SRI performance, which is really interesting. It really kind of depends on what data set you're looking at and the time frame that you're looking at when you're doing this analysis. And on the quality side, that was great that you mentioned that, because I was going to ask you about that. With governance being so important, I think, in these areas, I was going to ask you, and I think you basically answered, it does have a feature very much like quality, I guess, or perhaps a correlation on the quality side. Perhaps my question for you as somebody that develops portfolios is, what do you look at first? Do you build a portfolio based on factors and then do an ESG overlay, or do you start with ESG, find all the great companies, and then divvy it up somehow?
It's a great question. There actually have been some papers written about this, how to incorporate factors with ESG. I think, unfortunately, the answer is, there are a lot of different ways to skin the cat. And what you need to kind of identify is, what's the tracking error that the person wants to take, right? How are they approaching ESG? So you have products out there that basically say, hey, look, I'm going to give you the return of the market. And I'm also going to give you, if you look at your impact return, it's going to be improved relative to market. Right? That is a certain approach. It's low tracking error approach. I've read pieces where that approach gets knocked because it's like, hey, I paid more for ESG and I got the same return as the market. It's like, yeah, that was the intention, right? The intention was to give you basically a market return, but to do it in a way that improves your impact score, right? So that you could say, hey, look, I'm invested in something that's better for my social preferences, better for the environment, and I'm not really giving up return. So that kind of objective is going to end you in a very different place than an objective where, you're dark green, so to speak, right? Where you're very much saying, no, I want to invest in strategies that are supporting renewable energy or supporting, as I say, clean water or supporting diversity on boards. That's very much a posture where you either have a very strong alpha thesis around that you think that's going to outperform, similar to the Thematics discussion, or you really want to support those beliefs and you view your assets as a way to do that. So, your return versus the benchmark maybe isn't the number one goal. Maybe your goal is to say, yeah, I want to make money and I want to be prudent, but once I check those things off, right, then I really want my assets to support something I believe in, right? And that's a consumption decision. So all of those things will go into how you would position and create that portfolio. But I do think it's possible to combine factors, standard style factors, and outperformance from those factors, particularly quality, with ESG. There's some, disagreement in the value and growth in some cases, right? Some of these ESG postures tend to be higher in growth and tech, which kind of pulls you away clearly from, say, a value factor, a low price factor. But it's a matter of, kind of combining these things in an intelligent way.
Yeah. And so what I got out of the homework that you sent me was which is great reading, actually, because what I basically got out of that was, in terms of the alpha thesis, and you can correct me if I'm wrong, is there was a weak link between ESG and outperformance, but there was a stronger correlation to ESG and lower risk. And whether it's litigation, things of that sort. And to that point, I think just in the news recently, I guess 2 Exxon directors were ousted for being insufficiently attuned to climate change. In the Netherlands, Royal Dutch Shell court ordered reduced emissions on an absolute basis by over twice that they had planned, by 45% by 2030. So there are things happening now where those risks are really highlighted, and I don't know, people have to be aware of that these days.
Ed, I couldn't agree more. And those sound bites are, as asset managers and advisors, you really have to be paying attention to that, because that is, from my perspective, the ESG thesis sort of manifesting, right? It's like that is the risk you're facing if you're not sort of postured in a way to at least consider this. So two things I would answer on the risk reduction. There is some evidence that these types of strategies can reduce risk as we think of it today, right? Volatility risk. So my co-chief investment officer, one of the founders of Envestnet, Brandon Thomas, did a paper with Giannis, the PhD at Envestnet. Basically what they said is the dispersion in returns is tighter for these types of stocks. So you're not going to have the tail events, which is a very positive finding, right? Because it goes to that quality idea, it goes to that defensiveness idea. But you're also raising a fantastic point, which is there is an ESG risk potentially inherent, right? And this is again going to things that we're seeing now, where regulations, expectations of business partners, expectations of clients and investors are that you are making a movement on this. And, kind of, are you positioned to do that or not, right? Do you have unburnable carbon sitting on the balance sheet that at some point just becomes, poof, the asset is gone? The last thing I'll say on this too is, the data, from my perspective, it's hard to make a statement on returns right now, right? The data is not there yet because we haven't had the transition yet, So if there's an alpha thesis on return, we kind of have to let that play out. The risk of it is that there's more investor interest than there is potential in the cash flow, right? So that we drive up the price collectively of renewables more than the alpha thesis supports. And that's what has to play out to determine whether, returns will be better or worse or the same, et cetera. But there's no doubt in my mind that as an asset manager and advisor, you have to be thinking about this. And certainly if you have clients who are interested in ESG, you have a lot of options for, approaching that market, whether, as I say, it be just, hey, give me market return with less ESG risk, or, I want to put some money towards this. I think this is where the future is.
So let's talk about implementation now. We talk about some of the different aspects of a portfolio and an asset allocation. What are some of the biggest challenges you face in actually implementing an asset allocation with funds or ETFs?
So I would say, it's down pretty well, right? The process of kind of putting together a good mutual fund portfolio or a good ETF portfolio. I think, the challenges on implementation side would be making sure you're trading well. So if I'm looking at ETFs, for example, if I'm going to trade with market orders, which a lot of systems do, that's fine. If you're doing really liquid stuff, and in theory, really, you should do limit orders if you can, right? Just to kind of protect. But most execution systems will kind of protect you from the seriously bad outcome. But if I'm into something that's relatively illiquid, now all of a sudden implementation becomes an issue. So if you're an asset manager that's put together an ETF portfolio with really illiquid ETFs, or even ETFs that can trade at a significant premium or discount, then that's something I should be taking into consideration, right? Is that something that should be traded via market orders? You could look at the whole thing and conclude, yep, the alpha thesis is there, or whatever whatever my reason is, I still want to go there. But be advised, total cost of ownership is a consideration, right? So how you're implementing that. I would say also what I think is going to be more and more the case, and certainly something Envestnet is focused on, is curated solutions, so that it's not just the mutual fund and ETF, right? It's, if I want a decumulation portfolio, I probably want an annuity in there. I probably want an annuity sleeve for longevity risk, right? To go side by side with equity for growth, bonds for, cash flows, et cetera. So how do I implement across that? How do I decide how much goes to one versus the other? How do I sort of own that together? I think what the clientele would love is a one account registration that owns everything in it. That's an implementation that we haven't hit yet. But how do you manage among the accounts maybe and manage cash flows? So I think those are all in the mix. But the great thing, Ed, is that that's what data and technology are making increasingly tractable, right? Things that just didn't really used to be in the possibility set before are now in front of us and say, yeah, we could see a solution to this.
All right, let's move on to something really exciting, tax policy.
Yeah.
That's also in the news.
Yeah, a little bit.
How are you guys thinking about the Biden proposal? And are you doing anything now to prepare clients and advisors with potential coming changes to the tax code?
Yeah, how aren't we thinking about it, I think would be. So we are, it heavily occupies our interests. We have an overlay service, which is we're sort of heavily kind of not only introducing to advisors, but enhancing to make sure that we can kind of cover a variety of assets. So the overlay, basically, if you have an equity SMA manager in our unified managed account program, you can keep that manager. You don't have to choose a tax managed quote unquote strategy. You can keep the manager you want. We will overlay it. So we will basically apply an algorithm that says, okay, we're going to get you as close to the target of the manager, but we're also going to manage taxes, right? We're going to continuously look for opportunities for that, for mitigating gains, for making short-term gains, long-term gains, et cetera. So that is a service that we are introducing advisors to say, okay, if you have clients concerned about taxes, which we know you do, this is a service you should kind of look at. We have an exchange. We actually just recently launched Transcendent. It's a trust exchange. It's intended to help advisors quickly access in a streamlined and digitized way the trust market. We know that one of the proposals on the books is, of course, dealing with the step up in basis and what that's going to look like, exemption, right? So estate tax exemption. So trusts are another kind of avenue that we think advisors should be looking at. I think, we do get advisor questions around, should we accelerate gains? That's a tricky game to play, right? Because you could, in fact, run into this retroactive. Now, do I think that's highly likely with all the getting through Congress on something like that? No, I don't. But it's interesting that Biden actually put it out there. What I would say to you is probably your best bet, generally speaking, is just to employ tax management in your portfolio. So we're trying to help clients with how they can do that, advisors and clients.
Does that tax management also include things like insurance or annuities as well?
Yeah, one of the exchanges that Envestnet works with, our insurance exchange partners with FitX, which is access to annuities, and tax is, of course, another reason that you might want to look at annuities. I mean, a good tax planning effort from among advisors, you really have a lot of tools out there, and it's a matter of looking at what is the client invested in? What do they want to be invested in? How do I best mitigate the tax liability while maintaining whatever the posture is of the strategy that they wanted to keep? I think for sure, the biggest thing I would say is that advisors engage their clients on this topic, right? Like don't avoid it. It's markets are going to do what markets are going to do, and you make your best effort at, getting a diversified portfolio together, one that kind of protects the client but has potential for growth. But then at the end of the day, there's not much an advisor can do to control the market, right? Taxes are a different situation. Taxes are something where if you're a financial advisor and you're stewarding your client's assets and you're not offering them opportunities to be more tax efficient, that's something where it's just kind of difficult to get past, I would think, for the client, especially in an environment like this where you have, a heads up that this is going to become an increasingly bigger part of the picture.
Yeah. Yeah, you need a way to kind of manage through government policies and things like that. When I started out my career, one of the things that I learned, I spent a very short time as a financial advisor, but had some good training. And a concept that really kind of stuck with me was just like having a tax management tool. Think of it as almost like three legs of a stool, if you will, where you have your taxable account, you have your traditional retirement tax deferred accounts, and then you had annuities or insurance. And I don't know if it was just a mechanism to sell more annuities and insurance, but it kind of made sense, kind of depending on the environment, how high taxes went or how low they went. You pull from different buckets, kind of depending on what the environment is.
Yep. The environment, the client's book, or the size of the assets, where are they invested? I think any of those are on the table for sure. Even looking at packaged products, right? Am I in an open-end mutual fund that is going to distribute a lot of gains, or am I in an ETF that's probably going to distribute less gains? It's kind of an unfair advantage, but that the law is such that in ETFs you can in-kind out low-cost basis shares. So, should you be looking at that? Are you in a strategy that could easily be kind of moved over to an ETFs type strategy?
Amen. Thank you for that. Go ETFs. So is there a topic, a long-term trend that you're watching that's top of mind for you, something you see playing out over the next several years?
Yeah, I wish we had done that question before ESG, because definitely ESG is the big one for me, right? Strategic beta will always sort of be, a key trend for me. But they're really past that, ESG and impact are where I have a lot of focus. Now, crypto as well. I think that's another one that we just all have to pay attention to. I think it's going to be really interesting because there's such a dichotomy in crypto. You've got on the one hand, all of these firms looking for ways to embrace it, advisors looking for how to put it into the portfolio. And then on the, custodians, et cetera, right? The whole financial services industry mobilizing around how to put crypto into a portfolio or think about crypto. And then on the other side, you have the possibility of regulation just coming in and kind of really, taking the rug out, right? Pulling the rug out from under everybody. So crypto's one that we definitely want to watch. It's definitely something, though, you have to offer a solution on or offer an answer to. I think, too, blockchain in general, right? So there's Bitcoin, and then there's the underlying technology there, blockchain, and how does the financial services industry, a lot of which is still running on old tech, right? How do we revolutionize over time and bring that kind of technology to bear? But I said all that, and really the one that I am most focused on is certainly impact, ESG, how that's going to filter into portfolios. Is there such a thing as an ESG or impact solution, right, in the future? Or is it just everybody kind of pays attention to this? It's the way of doing business.
It kind of feels like that's where it's going, where, yeah, to your point, everybody pays attention to it. We're all ESG at some point.
Yeah.
What do you attribute the latest surge, or hopefully a lasting surge, in interest in ESG? Do you think it's a demographic thing? Do you think something else has really influenced people's demand for it?
I think a couple of things. Demographics is part of it. Certainly the surveys and studies that you see say millennials are more interested, but we're increasingly seeing other Gen X, right? Even baby boomers increase interest there too. So demographics have some piece to play in it, but I think it's also increased interest from, the regulatory side, from, governments and what's going on in the science of, say, climate change, right? We had during the COVID period just a marked view on social issues that we really haven't tackled, right? That are just sort of simmering in there, and something that I think most Americans want to see us tackle and would like to, or certainly come to terms with. So I think all of those things, it's demographics for one, but it's just the confluence of these other factors as well that are really putting a spotlight on ESG. And ESG performed really well during the COVID period, which is a short-term time frame, but people pay attention to short-term time frames.
All right. So how about this? Are you ready for trend or fad?
I'll do it. Yes.
Okay. It's not that scary. Alternative protein, trend or fad?
Trend.
Meme stock trading, trend or fad?
Fad, I hope. I really hope.
CGI fashion models, trend or fad?
I'm sorry, I have no idea what you...
It was crazy. I came across this thing where there are these digitally created models that show off, or that model fashion wear, and they have Instagram accounts, they sell brands, and it's fascinating.
And they're fake.
And they're totally fake. They look fantastic. They look almost real, but it's crazy.
Are they designed to be perfect specimens so that everyone can not,
Oh, actually, not every one of them. There's some that have larger bodies or whatever, more natural bodies. But it sounded like some model firms or agencies were signing at least one up anyway that I came across.
I guess I'm wondering why not use a person, but that's just me.
Yeah, I'm with you there. Inflation, trend or fad?
I think fad for now. I think the Fed will have to react at some point if it gets out of hand. I think they'll let it go for a way. I really do. I don't think they're going to move on 3. It's going to have to get to like 4 or 5, but they will react eventually.
And then the last one, which has been one of my favorite ones to ask over the pandemic, Connected home fitness, trend or fad?
I got to think that's a trend. I think we've all learned to do a lot in our homes, and it's, the convenience of that is not going to go away entirely. Even though we're all dying to get out, at the end of the day, we've all learned about convenience and efficiencies that we're not going to give up so easily. My 2 cents.
Excellent. Well, thank you very much for this. This is a lot of fun. I appreciate your time. What's the best way for people to find you, connect with you, and learn more about what you're doing?
It's LinkedIn for sure. That's my social media platform. I don't really embrace the other platforms. I don't know how people have the time to do all of these other platforms, but you can find me on LinkedIn for sure.
Fantastic. Dana, well, again, thank you very much for your time.
Thank you. It's been great.
And thank you for tuning in to another episode of Trends with Benefits.